Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Tuesday, May 25th, 2021. We're going to start out here with a quick update on the broad markets. Nothing much to update since the last post I made on the homepage. In fact, I actually followed up in the comments section below after the previous post updating these futures and showing where we're at. You know, we had, as mentioned earlier, we had breakdowns on both the S&P 500 futures, ES, as well as the small cap futures, the Russell 2000 index, RTY, and but not yet on NQ, or at least not what I'd like to see. I'll get to that in just 1 second. So there it is, divergent high, watch, rinse, repeat stuff. Divergent low was a catalyst for this rally. That divergent high was a catalyst for that drop, and so forth and so on. So there it is, a sell signal on ES and a sell signal on RTY, which I'll get to in a second, but not yet on QQQ or NQ. Let me grab RTY for you right here. There it is. And, zoom in a little tighter. You can see what's going on today. You can see, again, this chart was already put out this morning, showing you the history of the divergent highs and divergent lows and the rallies that ensue. And, it wasn't by coincidence that, or just random, that I put out charts of the futures this morning. Lately, I've been posting QQQ and SPY in the pre-market session or right after the open, either or. And but I noticed these nice clean uptrend lines, and they all aligned well. We had this uptrend lines on all the major stock indexes that I follow, the S&P, NASDAQ, and the small caps. And again, you can see the breakdown looks pretty legitimate on RTY as well. We'll zoom in a little tighter. You can see that. There's your candles. And then on QQQ, or NQ, I should say, we don't have a solid breakdown yet. That's why I always use the verbiage. You want to see a solid break and or solid 60-minute close below the trend line. So what we had when the other two broke down today at the same time earlier, NQ was at support, the uptrend line. Again, the comparable uptrend line. Here, we'll zoom in nice and tight. And pretty much all day it's flirted with that level. So when I zoom in real tight, you can see a few candles below, but these are not impulsive at all. In fact, they're tiny little candles, little doji sticks. And so that is definitely not a solid break, and we had that intraday spike on that big red candle there. That had the potential to give you a sell signal, but they parked it right back above the trend line. And then since then, we've been moving sideways. So where we go from here, we'll either get a sell signal, confirm it, and then if NQ does move down, start to move impulsively lower and get a solid close below the trend line, that will give us a sell signal here on NQ, but it'll also confirm the sell signals on RTY and ES. Otherwise, as I've said 100 times, I won't go long or short the S&P 500 or the Russell 2000 or the NASDAQ 100 unless they all break down, especially when they're all flirting with support or resistance, because that's what will happen sometimes. A couple of them break down, and then the buyers step in on the other one, keep the trend intact, and then those that broke down, in this case, maybe we'll see what happens, ES and RTY, prove to be whipsaw signals. So that's where we're at, and I just wanted to clarify we're trading ever so slightly below the trend line, but again, nothing impulsive. You want to see a solid breakdown, solid close down below that level, impulsive selling, and all that stuff. And then targets already listed on the chart. Now let me show you QQQ since I didn't update it today. I want to just do a quick update for you there. Remember the sell signal, and I mentioned this in the post this morning. I don't believe I included this chart right here. Was our sell signal back in the beginning of May? That was May 4th. And this for a while was a level I was watching, about 334 when we were back here, and that was it. So boom, we got our sell signal on the Qs. Qs also had the biggest drop, and they had the most bearish chart at the time. We hadn't broken down on the S&P 500 yet, and so a nice correction ensued. And then that ended with this 60-minute divergence here, which has so far been the catalyst for this rally. But my point is, we've come full circle. That was our sell signal, our breakdown. That was a very significant support at the time, and support once broken becomes resistance, and we're back to it now. So Something to note there. All right, now let's roll into quick update on some of the trade ideas that I've highlighted recently, including, we'll start with the ones I shared yesterday, with starting out with ZS. ZS are soybean futures, or you can trade the ETN with the ticker SOYB. That's your soybeans ETN. And this one, we broke out yesterday, where we had this wedge, and I said, break out of the wedge would be a buy signal, or a pullback. Like to see it come down here, and now it has to that 1500-ish support. It's about 1500 to 1495 or so right there, and you can see that's about exactly where we pulled back. So it's definitely offered once again an objective long entry on the pullback here to all this is so far is a breakout of a bullish falling wedge pattern and a back test, and that back test coincided with dual support levels, so all the better. You had a back test of the trend line and that price support channel or zone right there, and so that's SOYB. Same targets listed as yesterday. Sugar SB was also mentioned yesterday. That one was an objective long here off the bottom of the support zone. Went on to break above the downtrend line on the bullish falling wedge. Came up very, very close, but hasn't yet touched my target. I think we'll get another thrust up and hit that target. And again, I'm looking at these as bounce trades. I have a little bit of some concern. A lot of these commodities might need a little bit more of a breather, but again, they're in a bull trend. Buyers will step in, as dip buyers often do. And so that one so far is good for, I think that's about a 4+% rally off the support zone. And again, close to that first target, but a little shy. And sugar futures, by the way, it's a pretty small contract if you want to trade sugar futures. It is, I think they're about 19,000 per contract is what each futures contract represents. So unlike some of the other ones, that are over 100,000 per contract on a lot of these ag commodities, this one, is a little more smaller contract size for traders that might not want to put over 100,000. Again, you buy one futures contract, it's highly leveraged, and I'm talking about your net exposure. And so this one's a little smaller, a little under 20,000, and again, still looks good, but that's the only target I'm giving it right now. I talked about it yesterday. You can certainly hold out for another leg up if you're a longer term investor. Just trail your stops up if that's your plan. And then HG was the other one I gave yesterday. Those are copper futures. And you had a nice bullish falling wedge breakout. You also had a pullback to that nice 445-ish support right there. Breakout, initial leg up. And I think we'll get another leg. And we actually pulled back today to this 450-ish support. That's a level I had on the chart as well yesterday. And so that also provides for an objective long entry right now. Maybe we get an ABC wave up and hit that 462.67 target there. And the downtrend line, that's still the target zone. And the US dollar still looks poised for a rally here. We're back to the bottom, that support zone. Remember, I have these three levels here I showed you recently, and the bottom level is around 89,659 or so. Pretty decent support, not super solid support, but decent. You had reactions there, one there, several recently as well, and a little dip. And I said you might get a little dip below to undercut, but even if we do, just like we undercut there, we had divergence in place, and that divergence was extended, and then that led to this rally that went all the way up to there. So we have an almost identical technical posture this time around, and there's your primary downtrend line. So you can either buy, scale in, or just take a hard position on the dollar support here, DX, US dollar futures, and or add on a break of the downtrend line and then swing it up there. You'll have you might get a reaction at that previous reaction high, but again, this is my target zone up there. And if and when that plays out, as I said, it might put some pressure on dollar sensitive assets such as gold and crude oil and things like that. All right, now let me show you. Let's see. I've got some long trade ideas in the auto sector, and it's actually the sort of the niche, the smaller ones, not the big, not any of the big automakers. Those I'm not crazy about the charts. I'm gonna roll into those in another video. What I want to do is just wrap this one up here and just focus on one stock, and it's more indicative of the overall bigger picture and some of the important things I'm watching. Like I've talked about the industrials. Go back to a daily chart here, XLI. And this kind of ties back into what I started at the beginning of the video, analysis on the broad market. So I showed you the S&P starting to crack, the S&P futures small caps. Pardon me, we used to call them small craps back in the 90s when everybody was large caps were in favor, and I was a stockbroker back then. That was the nickname for the small caps. But they're higher growth companies than large cap companies. But when they fall, they tend to fall harder. Anyway, this is back to let's get on task here. Xli Industrials Etf. One of the big sectors in the S&P 500, one I've been watching, and we're dancing right on the line. Talked about this. You look at this. Zoom in. This isn't mere coincidence. Look how small these candles are. They're just tiny little dojis each day for the last several days, smaller than just about all the other series of candles, and that's because we're hugging this key uptrend line support. So again, we're sitting on the proverbial edge of a cliff here, but we're still on that cliff. The market hasn't fallen off. So this is one sector I'm watching for. And again, I do these videos, I get them out in advance, because if it happens, being that a lot of these key sectors, such as XLI, XLV, healthcare, sitting right on the trend line, could break any day now, or not. That's the thing. Trend is a trend unless broken. I say that all the time. And right now, it hasn't been broken. There's XLF, big one right there, financials. And but again, just hugging the line, and the divergences tell me that a breakdown is most likely imminent. Imminent can be, could be a matter of days, could be a matter of weeks, maybe months, probably not. Imminent more that day to weekly, several weeks, within several weeks kind of time frame there. But here's the thing, until we get those sell signals, market's not going to go much lower, even with those breakdowns on the 60-minute chart. Remember that the ES chart I started with and QQQ, those are only 60-minute charts. These are more significant and take precedent, the daily time frame. All right, we're doing real good on time, so I'm just going to talk on one stock, one of my favorites in the sector, in the financial sector, and it's sort of indicative to the posture on a lot of these stocks. And that one is T. Rowe Price. I'm sure a lot of you out there listening to my voice are familiar with T. Rowe Price. They are a big mutual fund company and a lot of 401k plans. You'll have choices with T. Rowe Price funds, and been around for a long time. But it's just a very tradable stock, and the trades well to the technicals. What I'm doing is scrolling back here. We're looking at a daily time frame, and what you can see, very simple stuff. You can go back to 2017 here. You have 1, 2, 3, and now 4 divergent highs, right? Very clear. I'm talking about negative divergence on the indicators down here. As the indicators are making lower highs, lower or equal highs, and prices are making higher highs. And so what I did, I measured out from each divergent high, showing you even, in a bull trend, here's what the corrections are on this one. 34%, about 41%, 15%, and that was coming off that, strong rally off, when the Fed came in with all the nuclear options there when COVID hit last year. And here we are. And what I like about this one is just how clean this uptrend line is. This is not just random drawings here. This trend line has been in effect with multiple reactions, and especially recently. So, again, when we're going to need to see the financials break down, because this is in the financial sector. And when we do, especially with you may get this one breaking down first, All I'm trying to say, it's not going to hit this, let's say, either these maximum. These are near-term targets, and we could certainly drop much more than that. That would be about a 24% drop. And again, it's in line with these recent drops from the previous divergent highs: 15%, 41, 34, and now I'm going to show you something on the weekly chart that I think is pretty interesting. Okay, so we look at a long-term chart. Now we're going back all the way into the early 90s right here. And so there's a couple things to note. Here's, like many things in the stock market right now, we're in a secular bull market. And within a secular bull market, that's the larger trend right here, over decades. You have cyclical bull and bear markets within there. These are your cyclical bull markets, cyclical bear market. I don't know if you can make these numbers out, so I'm going to read them out to you. So what I've done here is marked on the weekly time frame, which is even more significant than the daily time frame, especially for you long-term investors, traders. When do you get out of your long positions in your 401k, things like that? When do you put on a short that you can tuck away for several months or more? That's when you use the weekly charts. When they give you buy or sell signals, that's when you go long or short for what I call a trend trade, and that's trying to capture the bigger moves. So going back, you can see these were two divergent highs, really just consecutive divergent highs. So that's really one divergent high. That's why I labeled it DH1, DH2. You had a divergent high there, followed by a 51% correction or bear market, and then the divergence extended and got even larger. And it's again the same divergence that started at this point. You had a little peak right here. If I draw the line, that was our first divergent line right there, and up to that point. And then the next drop, once we got the larger divergent high, was 58%. I'm going to show you something here, what the Fed has done historically in times like this. And just keep in mind, this is going to mirror pretty much XLF, the financials, and the stock market, these big rips and dips in T. Rowe Price. So that was it. We had a bear market back in the, after the dot-com bubble burst right here in early 2000. That was followed by a 58% bear market that went all the way into late 2002, followed by the next cyclical bull market right there. You had a shot across the bow. We put in divergent high 1 right here, followed by a 34% drop with a snapback rally that took us to new highs, but that only extended those divergence, and then the big drop came, 71% bear market, and that was a pretty swift one too. There's a good example of how stocks can fall a lot faster than they rise. In a matter of mere months, you wiped out many, many years of gains. And then we came full circle here once again, divergent high in about the beginning of the year, December, about late 2014, followed by a 29% drop off that divergent high. And then most recently, we had a divergent high right here, and that was pretty clear divergence at the time, and that was heading into the March highs. So as I've talked about many, many times over, COVID certainly exacerbated the speed of the drop, but it was, there was a correction coming priced into the charts based on the technicals already with the divergences and little minor trendline breaks, things like that. So that was a 41% drop. And what happened? Fed came in with the nuclear options and took this stock up to all-time highs, and all that did is extended from this point here. It is only extended and put in an even much larger divergent high. So bare minimum, looking at this, I'd say we come back down here again, and that was certainly, this whole move right here. A lot of stocks broke down. A lot of long-term trend lines were taken out at those lows in the panic selling, but the Fed came in, and it's what I like to call Ursa interruptus, meaning a bear market that was interrupted by the Fed with, just again, unprecedented stimulus for the economy and the stock market. Okay, so there's one more point to this. So the takeaway is to recognize, these developments on these longer term charts that we're seeing, and then kind of gauge how long how much we can fall in percentage terms and how long it can take. And so at this point in time, here's that trend line I showed you on the daily chart. There are no sell signals on T. Rowe Price, but when we get a sell signal, as I just showed you on the daily chart, my targets range from, at bare minimum, move down from where we're at today to about 167.36. That'd be 11% drop, to maybe down here at about 142, which I think is a very likely and probable target. That's about a 24% drop. If we go up another 10% before we break the trend line, then we're talking a 35% drop, so forth and so on. But what I want to show you is let's loop in the Fed and what the Fed has done, and in each of these instances here, because as I noted, a lot of times you had a divergent high and then what I call a shot across the bow, the initial drop, followed by another strong run up to put an even larger divergent high, then followed by an even larger drop. In this case, 58% and then 71%. Here's our DH1 and this is DH2. So therefore, there's a good chance we're going to have a much larger drop when we finally reverse course and start a new downtrend on T. Rowe Price. So here's what I wanted to show you. All right, so what I pulled up on the bottom of the screen, and I haven't found a way to really make this any bigger. I know in the videos you might not be able to make it out, but I'll read out what I'm doing here. Okay, so we're over about the same time period. This is 1993 on the left of this chart. This is the Fed funds rate. So it shows you the Fed, when the Fed's hiking rates right here. Let me color this up. Let me change the there it is. So there's the Fed hiking rates and there's the Fed lowering rates, right? And these shaded gray areas are recessions. This is this yellow one right here where we're at right now. Okay, so you can see back here, I'm going to put the crosshairs, that was in that peak, that divergent high came in about the middle of 1998, right? Right there, July 17th. And go back here, and so what we had 1998, we go back right here, see that? Boom. And this is not mere coincidence. See this drop right here? That was right when T. Rowe Price, and again, keep in mind the financial sector would have been falling along with it. So what does the Fed do? They come in and they start cutting rates because they see the stock market correcting, and that's what they don't like that. And also, the market tends to correct with economic expectations, indicators and things roll over. So what do? They give the market some juice. Right, and sure enough, that juice correction stopped, and they juiced the market to new highs with that cut. They tried to take some of it back there, and they did. They took some of it and then some back until right into when the .com, right after the .com bubble pop. That says June of 2000. That was right here. That was 2000 right there, right around the same time. And so a couple of takeaways here. Number one. And I always hear people say, don't fight the Fed, don't fight the Fed. Go back in history, in most points in time, you would have done better shorting when the Fed began a rate cycle or getting out of or rate cut cycle or getting out of your longs, because they do that often once a recession's already started. The Fed has historically always been behind the curve. And so again, that was perfect timing. So again, we had a drop right there, Fed cut, they gunned it up to higher highs, and then a much bigger drop, even though the Fed aggressively cut rates at that point. Again, that was back here, 2000, this was that aggressive cut. And they didn't stop cutting until the bear market was over in 2003, right there, and that's when this one bottomed. There's 2002, I'm sorry. 2002. All right, so now let's go here, right here. That first top right there in 2000, that was about November of 2007. Let's see what the Fed was doing at the time. 2000, there it is. There's the top right there. There's 2007. And so T. Rowe Price, as well as the financials and the markets, started to fall, right? What did the Fed do? They started to cut. They gave the market some juice, right? Right here into 2008, they were still cutting. And then you look up top, boom, that gave that life. Everybody bought, oh, okay, Fed's being easy, they're cutting rates. And all it did is simply set up the stage for an even bigger drop, because it gunned the market up. The economy had already started turning, the financial sector and everything else. And so, People bought the rate cuts as they often do, and again, it didn't change anything from a technical perspective. Here's my thing: I don't, wouldn't say short or go long or get out of longs just because the Fed is cutting. Don't. It's not about being contrary for the sake of being contrary. If the technicals don't confirm or refute going long, then you don't want to do it, regardless of what the Fed is doing. That's my point. So if you bought that high thinking, oh my gosh, the Fed was so easy, which they were getting very easy back in that point in 2008, you then lost 71% of your money right there. Okay, now this is where things start to get a little bit different. The Fed, after that last financial crisis, kept the pedal to the metal. They had some opportunities, I think, back then to take rates up. That top right there and that divergent high occurred right around the beginning of 2015 into 2014, and that was followed by a 24% drop in T. Rowe Price. And you can see the Fed was already at the bottom, so they had no more downside to go. They weren't able to cut, but they kept things there, and they probably upped their bond purchases, which is another form of easing. And so you had the 29% drop, but then T. Rowe Price started to rally. So here it is. Now we've come full circle. There was the first divergent high. Since then, we had right here, divergent high leading into about February or so of 2020, followed by a 41% drop. And that's when the Fed took rates down to the floor again and gave us this gun up here, just like they did here, and just like they did the time before that right here. So, this is it. I know a lot of talking, but it's that whole kind of where are we, or where are you? When you walk into the shopping mall and they give you a map of the mall and different parts of the mall, and it's a little arrow says you are here. Well, that's where we're at, somewhere there. We had a correction, a bear market priced in. Some might say that 41% drop and the big drop we had in the market satisfied it. I don't think so. It happened so quick that it didn't allow that normal flushing out process. Bear markets and recession are all about businesses that are no longer or haven't been operating efficiently because they've been in a rising tide, a strong economy. They need to get washed out. And then the survivors and the companies that come through it are leaner and meaner. They're more efficient. And that's what bear markets are natural, and recessions are a natural part of the business cycle. The Fed didn't allow that. They didn't allow anyone to go bankrupt. They kept businesses afloat. Payroll protection plan, stimulus checks for everybody, they bailed out the airline industry and everybody else. And so really, that was a blip. And it certainly, although it was a big drop, it wasn't enough in time. So now, economy's strong. It's chock full of stimulus money right now. We're coming back online. But again, technicals, to me, are the bigger determinant of where stock prices are going, because the market always looks 6 to 9 months ahead. And so how much of this huge run up, and a lot of companies, including T. Rowe Price, have already priced in the most optimistic best case scenario and the bump. So I'm going to leave it here. Hopefully you like these kind of longer term outlook and analysis, and again using this is kind of a hybrid, I guess you'd call it, of technical and fundamental analysis, because this is fundamentals, talking about what the Fed did, how they acted. And history doesn't always repeat, but it often rhymes. So they say those who ignore history are doomed to repeat it. Do you go shorting T. Rowe Price in the financials now? No, but you get ready. Because a little more downside, and you'll have a sell signal in T. Rowe Price. And if you want to increase the odds substantially on that short playing out to those targets I gave you, you want to see the financials break down. And it's not mere coincidence that they have almost identical trend lines, and so they probably will break down on or around the same time. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.